Assalamualaikum, my name is Nur Aldiyana Binti Omar from DBM F5A. My student ID is 2017-588967. For now, I would like to present about my assignment for subject code FIN546 Islamic Finance, and I need to present for chapter 4 about Islamic banking operations and instrument. Islamic finance refers to how businesses and individuals raise capital in accordance with Sharia or Islamic law. It also refers to the type of investment that are permissible under this form of law. Islamic finance can be seen as a unique form of socially responsible investment. Islamic finance began in the 7th century, which is it has been formalized gradually since the late 1960s. The concept of risk sharing is central to Islamic banking and finance. It is essential to understand the role of risk sharing in raising capital. Islamic banking exists to further the socio-economic goals of an Islamic community. Islamic law views lending with interest payment as a relationship that favors the lender, who charges interest at the borrower's expense. Conceptual balance sheet of an Islamic finance institute. In Islamic finance, the term loan refers only to a benevolent loan, a form of financial assistance to the needy to be repaid free of charge. Other instruments of Islamic finance are not referred to as loans, but rather as financing modes falling under one of the three categories. First is profit and loss sharing. The second is non-profit and loss contract, and the last one is free-based product. PLS financing is close to the spirit of Islamic finance. There are two types of PLS financing, which is musyarakah and mudarabah. Musyarakah is profit and loss sharing partnership and the most authentic form of Islamic financing, and mudarabah is profit sharing and loss bearing contract where one party supplies funding and the others provide effort and management expertise with a view to generating a profit. Non-PLS are most common in practice. They are generally used to finance consumer and corporate credit, as well as asset rental and manufacture. Non-PLS financing instruments include murabahah, ijarah, salam, and istisna. Murabahah is a popular Sharia-compliant sales transaction mostly used in trade and asset financing. Ijarah is a contract of sale of the right to use an asset for a period of time. Salam is a form of forward agreement where delivery occurs at a future date in exchange for spot payment, and istisna is a contract which a commodity can be transacted before it comes into existence. For free-based product, Islamic bank offer a wide spectrum of free-based service using three types of contract, which is wakalah, kafalah, or ju'ala. They are usually auxiliary to the main murabahah and mudarabah transactions. They are generate various types of fees and commissions. The fee-based service provided by Islamic banks include bank transfers, issuing letters of credit and guarantees, credit cards, and offering collection and safe custody services, mostly used in trade financing. There are basically two principal sources of funds, namely work capital of shareholders and customers' deposit. A separate accounting system is adopted for a dual-window banking operation, which separates all Islamic bank funds from conventional banking and to avoid the arrival of funds. The initial paid-up capital usually is provided by a conventional parent bank on a benevolent loan, and hence there should not be any problems with the sources of the funds because Muslims have challenged the sources of capital invested into the scheme. The scheme is a dual-window banking operation. The following sources of money that risk-free and non-return earning are used by Islamic banks. Among them are: one is capital and equity. Capital is the sum injected into the Islamic bank during the establishment, namely the Islamic bank's paid-up capital. In general, equity is the Muslim bank's retained earnings accruing over its period of operations. Transaction deposit divided into two, namely current account and savings account. Current account are based on the wadi'ah concept, which promises return of their funds to the depositors and the choice to be paid in full upon demand. And saving account vary in terms of interest received by depositors based on their annual performance from new deposits. A savings deposit also permits customers to deposit and withdraw their money at any time and does not require a minimum balance in the deposit account. Investment deposit, usually known as a profit and loss sharing account, divided into three, namely general investment account, specific investment account, and commodity murabahah. For general investment account, it has a set income sharing distribution with predetermined ratio and maturity period for the investment account. While for specific investment account, this is a special investment tool that tells depositors of the location of assets, the total sum they can spend, the expected gains, and the commitment risk involved. And for commodity murabahah, this is another way of unique contract for deposit. Under the contract murabahah, Islamic banks offer an Islamic fixed deposit returns to depositors. Uses of fund is a process of investment of the resources of Islamic banks based on the principle of prohibiting the usurious interest. Therefore, they practice their investing activities of the resources away from the basis on which the activity of giving loans and credit depends in the non-Islamic bank. Work in investing the resources of Islamic banks starts on the basis that making profit is not the sole aim, while it is one of the basic aims because it is an important component that enables the banks to continue and attract new resources, especially the deposits of those who deal with the banks. As for the methods available before Islamic banks in investing fund are as follows. Establishing direct projects. The bank with its special system invests the fund in some projects administered by a special system in them that study these projects and make sure of their liability and effectiveness, carry out, administer, and follow up them. This project will remain under the complete ownership and authority of the bank as long as keeps the capital. Establishing project in conjunction with others. The bank will, in conjunction with others, whether they are organization or individual, establish a new project or buying a ready one that has an independent legal entity away from the entity of bank. It often takes the form of the capital company. The role of the bank is defined in these projects according to the value of its contribution, either by quota or shares, and the extent of the bank participation in the actual administration of the company. This is one of the most common forms in many of the current Islamic banks. That is because it enjoys a complete legal protection for the funds of the Islamic banks. Financing through partnership. It is when the bank has a share in the capital of the project. This will result in making the bank a partner in the ownership of this project, as well as administrating and supervising it, and also a partner in all results of profits and losses according to the agreed ratio. That is because the Islamic banks depend on the Islamic special perspective and teachings concerning transaction, and thus its direct investment or partnership are subjected to the criteria of allow and prohibit matters that Islam outlines. Financing through murabaha. This form of the means of financing depends on the basis that it is one of the allowed forms of transaction in the religion of Islam. It means that the bank sells what it bought previously in its original price along with an excess of profit on it. This form is applied to the local and foreign trade. Direct trading. This way is like the direct investment that is free from all religious prohibitions. Accordingly, banks represented in their experts who supposedly have complete knowledge of the condition of the market and its needs, buys the commodities that the market needs and resell it in suitable prices, providing keeping away from exploitation or monopoly. Sale of salam, buying in advance. It is one of the ways of Islamic trade transaction. Its main idea bases on the fact that an individual has the required money as a price of a commodity. However, the seller does not have the required commodity. Accordingly, the buyer will pay the price in advance or at once or in different times to the seller, who should deliver him the required commodity in the agreed specification and in the time and place defined by the contract, in addition to the different previous forms of employment and investment. Mudarabah. It refers to the agreement in which a person gives an amount of money to another person in order to trade with it, and the second takes a share in the profit, like a half or a third, and the like. It is a contract between the owner of the funds who provided money and the mudarrib, which is person or company or band or etc., who provided work. Relationship between the Islamic banks and users of money is often governed by the relationship of limited mudarabah. Sale of ta'jiri, which is leasehold. It is a financing form combines both selling and hiring. This form is used in the capital equipments and housing units. According to this form, the bank will buy equipments or build the housing building and sell it in a specific value and make an agreement with the customer not to transfer the ownership to the buyer in return for exempting the buyer from paying the full price all at once, and when all installments are paid, then the ownership will be transferred to the buyer. Islamic trade financing and instrument divided to 5, which is Islamic letter of credit, Islamic accepted bills, Islamic trust receipt, Islamic bank guarantee, and the last one is Islamic shipping guarantee. Islamic letter of credit is a written undertaking given by the Islamic bank to the seller at the request and on the instruction of the buyer to pay at sight or at a determinable future date a stated sum of money within prescribed time limit and against stipulated documents which must comply with terms and conditions. Under ILC have 3 types of letters, which is Murabahah Islamic letter of credit, Musyarakah Islamic letter of credit, and Wakalah Islamic letter of credit. Islamic accepted bill, also known as interest-free accepted bill, which is IAB, was introduced in 1991. The objective of introducing IAB is to encourage and promote both domestic and foreign trade by providing Malaysian traders with an attractive Islamic financing product. The IAB is formulated on the Islamic principle of Al-Murabahah, defer lump sum sale or cost plus, and buy at din, which is debt trading. There are 2 types of financing under the IAB facility, namely imports and local purchases and export and local sales. Islamic trust receipt is a financing facility to finance domestic or international trade documents drawn against ILC or Wakalah inward bills for collection. Islamic banks issue ITR facility to the customer based on the Murabahah principle for financing the purchase of goods. It is a document of trust signed by the customer, the strength on which the Islamic banks allows the customer to obtain release of the merchandise but makes a lump sum payment at a later date. Islamic bank guarantee is an indemnity letter in which the Islamic bank commits itself to pay a certain sum if a third party fails to perform or if any other form of default occurs. Islamic shipping guarantee is a letter of performance and indemnity issued by the Islamic bank on behalf of the buyer or importer. It is a contract where the Islamic bank agrees to discharge the liability of the third party in case of default by the third party. The conclusion is the Islamic banking and finance in Malaysia start with single Islamic bank in 1983 to become one of the most progressive and innovative in providing Islamic banking service and products. The ultimate goal of establishing in an Islamic financial institution is to verify that its operation and products are Sharia compliant. The development of human capital is seen an essential for Malaysia Islamic financial system to remain competitive and producing more innovative Islamic financial products. For each Islamic financial institution has its own set of processes. There are no standard criteria for in terms of management, product approval, or other issues.